What if I told you that everything happening in the silver market right now, the crash, the manipulation, the vault drains, all of it, was predicted in a single email 15 years ago? And what if I told you that email was sent to Jeffrey Epstein? Welcome to Finance Currency, and today I'm going to show you something that will fundamentally change how you see the silver market. I need to be very clear about something before we begin. What I am about to show you is not speculation. It is not a conspiracy theory. It is not something I heard from someone who heard from someone else. This is a real document, released by the United States Department of Justice, available for anyone to read. And it contains a silver market thesis so accurate that when I first read it, I had to put my phone down and walk outside. Because this email, sent in May 2011, describes exactly what happened to silver in 2026, word for word, mechanism by mechanism, price target by price target. Let me tell you how I found it. In January 2026, the Department of Justice began releasing documents related to Jeffrey Epstein and Ghislaine Maxwell. This was mandated by the Epstein Files Transparency Act, signed into law in late 2025. The release was massive. Over 3.5 million pages of documents, emails, bank statements, wire transfers, portfolio records, flight logs, FBI interviews, everything. The entire world focused on the political names, presidents, princes, tech billionaires, Hollywood celebrities. And I understand why. Those names generate headlines. Those names generate clicks. But I do something different on this channel. I follow the money. While everyone else was searching for famous names, I was downloading financial documents, bank statements, investment records, communications between Epstein and his wealth managers. And that is when I found it. An email dated May 27, 2011, sent by a private banker named Bernard to an email address associated with Jeffrey Epstein. The subject line alone made me stop scrolling. Power of attorney, silver, syntropy. 3 words that should not be in the same email unless something very specific is happening. Power of attorney means someone is managing money on behalf of someone else. Silver means precious metals investment. Syntropy is a European investment vehicle. This was not a casual email between friends. This was a financial professional communicating investment strategy to one of the most connected financiers in modern history. I opened the email, and what I read made my entire understanding of the silver market shift. Bernard was leaving his position at a Swiss private bank called Artis. This is not a regular bank. This is the kind of institution that manages money for people whose net worth starts with 9 figures. He needed Epstein to sign power of attorney documents so he could continue managing the account from his new position. That alone tells you something important. This relationship was so critical that even when Bernard changed jobs, the first priority was maintaining control of Epstein's money. But that is not what stopped me cold. What stopped me was the next paragraph. Bernard writes, and I am quoting directly from the document, "I have also enclosed some research I made on the silver market, and I am fully convinced that a squeeze is possible if one can take delivery of 100% of the futures contracts." Read that again. A squeeze is possible if one can take delivery of 100% of the futures contracts. In 2011, a private banker to Jeffrey Epstein wrote a detailed thesis about how to squeeze the silver market by demanding physical delivery of all futures contracts on COMEX. And he did not just mention it casually. The email had attachments, a silver executive summary, a CME position limits document, research on silver mining companies. This was not speculation. This was a structured investment thesis being presented to someone with the resources to potentially execute it. Now, you might be thinking, okay, someone wrote about silver in 2011, so what? People write about silver all the time. But here is what makes this different. Bernard made specific predictions in that email, specific mechanisms, specific price targets, specific timelines. And almost every single one of them has come true in 2026. Not approximately, not kind of, not in the general direction, word for word. Let me show you exactly what I mean. In the email, Bernard describes how the silver price had crashed from nearly $50 to $30 in 2011. He explains that the CME, the exchange that handles silver futures, had raised margin requirements 5 times in a row. He calls this what it actually was, a flush of weak hands. He writes that the margin increases did not change the fundamentals. They did not change the supply deficit. They did not change industrial demand. They only eliminated the leveraged speculators who could not meet the margin calls. Now let me tell you what happened in 2026. Silver ran from $37 to $121. Then the CME raised margin requirements from 5% to 8%, then to 11%, then to 15%, then to 18%. The price crashed from 121 to 64, the exact same playbook, 14 years apart. Bernard identified this mechanism in real time in 2011. He understood that margin manipulation was a tool to flush weak hands, not a reflection of fundamental value. And he predicted that the fundamentals would eventually win. He was right. Here is what Bernard predicted in that email. Silver would reach $60 by end of 2011. He was wrong on timing, but right on direction. The inflation-adjusted value of silver was $150. The gold to silver ratio would fall from 40 to under 20 within 36 months. Now let me show you what happened. Silver today is trading at $82, higher than his $60 target just 14 years later than he expected. His inflation-adjusted value of $150 in 2011, adjust that for 14 more years of inflation. You get over $220 in 2026 terms. Silver at $82 is trading at roughly 1/3 of the value Bernard calculated using fundamental analysis. And the gold to silver ratio? In 2011, it was at 40. Bernard predicted it would fall to under 20. Right now, with gold over $3,000 and silver at $82, the ratio is around 37. It has been compressing exactly as he predicted, just on a longer timeline. This man was not wrong. He was early. And in markets, being early and being wrong look identical. Until suddenly they do not. This is Finance Currency. Subscribe if this is your first time here because I cover what mainstream financial media refuses to touch. Now I need to show you what was happening in the accounts connected to Epstein's inner circle at the exact same time, because this is where the story transforms from interesting to disturbing. Alongside the Bernard email, the Department of Justice released another document, a J.P. Morgan Chase portfolio statement. The account holder is Ghislaine Maxwell. The document is marked Confidential Treatment Requested by J.P. Morgan Chase. It was never meant to be seen by the public, but here it is, released by the DOJ, available for anyone to download and read. The statement covers December 2010. This is 5 months before Bernard sent the Silver Squeeze email to Epstein. And what does it show? It shows that Ghislaine Maxwell was actively purchasing shares of First Majestic Silver Corp through her J.P. Morgan account. Let me tell you about First Majestic because this is important. First Majestic is not some random mining company. It is one of the world's premier pure-play silver mining operations, listed on the New York Stock Exchange, operations primarily in Mexico, one of the largest primary silver producers on the planet. In 2026, First Majestic's share price is up over 130% since January. It has been one of the best performing silver stocks of the year. Ghislaine Maxwell was buying it 15 years ago. The portfolio statement shows the following transactions. November 29, 2010, purchase of 100,000 shares of First Majestic Silver. December 6, 2010, purchase of 3 million shares of First Majestic Silver. 3 million shares through J.P. Morgan. The total cost on the statement shows approximately $41,000 for these transactions. Now, I need you to understand the timeline here because the sequence matters. December 2010, Maxwell is buying millions of shares of a silver mining company through J.P. Morgan. May 2011, Epstein's private banker sends a detailed silver squeeze thesis with CME position limit attachments. Same network, same time period, same asset class. Coincidence? Maybe. But let me add another layer. J.P. Morgan, the bank holding Maxwell's account, the bank facilitating these silver stock purchases, would later be caught manipulating precious metals markets. In 2020, J.P. Morgan paid a $920 million fine for manipulating gold and silver prices. Let me explain what they were actually doing, because it connects directly to everything we are discussing. J.P. Morgan traders were convicted of spoofing. Spoofing is a market manipulation technique where you place thousands of fake buy or sell orders that you never intend to execute. The purpose is psychological manipulation. If other traders see massive sell orders, they think the price is going down and they sell too. If they see massive buy orders, they think the price is going up and they buy. J.P. Morgan would place these fake orders, wait for other traders to react, then cancel the orders and profit from the price movement they created. They did this in gold and silver markets for over 8 years, not 8 months, 8 years. Multiple traders were personally convicted and sent to prison. And here is the part that should make you pause. The head of J.P. Morgan's precious metals desk was found guilty of racketeering, not securities fraud, not market manipulation, racketeering. That is the same charge they use against organized crime, against the mafia, against criminal enterprises. A federal court determined that J.P. Morgan's precious metals operation functioned like a criminal organization. Now let me connect the dots. Epstein's network is discussing a silver squeeze based on physical delivery mechanics. Maxwell is buying silver mining stocks through J.P. Morgan. J.P. Morgan is simultaneously suppressing silver prices through illegal spoofing. If you wanted to accumulate a massive position in silver before a squeeze, what would be the ideal scenario? You would want the price suppressed while you buy. You would want to accumulate as much as possible at artificially low prices. Then you would want the suppression to end and the price to rise to its fundamental value. I am not saying these activities were coordinated. I do not have proof of coordination. What I am showing you is a pattern, a convergence of documented activities that all point in the same direction. And I am saying that nobody in mainstream financial media is connecting these dots because the Epstein files are so massive that the financial connections are being ignored. Everyone is focused on the celebrity names. Nobody is following the money, except us. Let me add one more piece that will make your head spin. In 2023, JP Morgan paid $75 million to settle claims related to their banking relationship with Epstein specifically. The bank admitted that they failed to properly monitor the accounts and transactions connected to Epstein's network. So the same bank that was manipulating silver prices, the same bank that was facilitating Maxwell's silver investments, the same bank that would later pay nearly $1 billion in fines for precious metals manipulation, that bank also had a direct financial relationship with Epstein that required a $75 million settlement. I want you to sit with this for a moment, because we are not talking about separate stories here. We are talking about one network, one set of relationships, one web of financial connections that includes a detailed silver squeeze thesis sent to Epstein, millions of shares of silver mining stocks purchased by Maxwell, market manipulation by the bank holding those accounts, and settlements totaling nearly $1 billion related to both precious metals manipulation and the Epstein relationship. The documents are public, the court records are public, the settlement amounts are public. None of this is speculation, it is all documented. Drop a comment telling me where you are watching from, because I need to know how many of you are following the files as closely as I am. If you have stayed with me this far, you now understand the historical context. A silver squeeze thesis sent to Epstein in 2011. Maxwell buying silver mining stocks through JP Morgan. JP Morgan manipulating precious metals markets for 8 years. But here's why you should care about any of this in 2026. Because Bernard's thesis was not just historically interesting, it was predictive. And it is playing out right now. Let me walk you through Bernard's core argument and show you how it maps to today's data. Bernard's thesis was simple. The silver market could be squeezed if someone takes physical delivery of 100% of the futures contracts. Futures contracts are promises to deliver silver at a future date. Most traders never take delivery. They sell the contract before expiration and pocket the profit or loss. But if everyone suddenly demanded actual physical silver instead of paper promises, the system would break, because there is not enough physical silver to cover all the paper contracts. Bernard understood this in 2011. In 2011, COMEX had enough registered silver inventory to cover the contracts. The squeeze was theoretically possible but practically difficult. In 2026, that is no longer the case. COMEX registered silver inventory has been declining for years, not slowly, in a staircase pattern, down, down, down. Shanghai silver inventory has collapsed from over 1.2 million kilograms to approximately 350,000 kilograms. London lease rates are at 4.5%. When you hear lease rates, think of it as the cost of borrowing silver. High lease rates mean silver is hard to find. 4.5% is extremely high by historical standards. The market is in backwardation. Backwardation means buyers are paying more for silver right now than for silver delivered in the future. That is backwards from normal market conditions. It signals extreme physical stress. Every single condition Bernard described as necessary for a squeeze is now present in the 2026 data. Not partially, not theoretically. Actually present, right now, in the numbers. Let me go through his predictions one by one. Bernard said the squeeze requires physical delivery. In 2026, COMEX delivery notices are surging. Large buyers are standing for delivery instead of rolling their contracts forward. They want the metal, not the paper. Bernard said margin hikes only flush weak hands. We just watched this happen. Silver ran to $121. Margins got raised 5 times. Price crashed to $64. Approximately 39,000 contracts were liquidated. But here is what is critical. During the crash, lease rates went up. Backwardation got deeper. The physical market got tighter even as the paper price crashed. The weak hands are gone, but the physical stress is worse than ever. Bernard predicted a supply deficit. In 2011, the deficit was small. In 2026, we are in the 5th consecutive year of structural deficit, and it is growing. Solar panel demand has doubled since 2011. Electric vehicles did not exist as a mass market in 2011. 5G infrastructure did not exist. AI data centers did not exist. All of these technologies require silver. The demand is structural. It is growing, and it is not going away. Bernard calculated an inflation-adjusted fair value of $150 for silver in 2011. Adjust that number for 14 more years of inflation, you get $220 to $240 in 2026 dollars. Silver is trading at $82. If Bernard's analysis was correct, and his directional predictions have been dead accurate so far, silver is trading at roughly 1/3 of fair value. 1/3. Now let me explain why 2026 is different from 2011. In 2011, the people trying to squeeze silver were retail traders and small funds. They used leverage. They traded futures on margin. When the CME raised margin requirements, these traders got liquidated. They did not have the capital to meet the margin calls. They were weak hands and they got flushed. The squeeze failed. In 2026, the buyers are different. China has implemented export controls on silver. The United States has classified silver as a critical mineral. Both superpowers are actively securing physical supply from Latin America. Sovereign wealth funds do not get margin called. Nation states do not panic sell because margins went from 5% to 18%. Governments take physical delivery, which is exactly what Bernard identified as the key mechanism. Take delivery of 100% of the futures contracts. That was his exact phrase in 2011. In 2026, nation-states are doing exactly that. Not to make a trade, not to profit on paper, because silver is now a strategic resource. Solar panels require silver, electric vehicles require silver, semiconductors require silver, military technology requires silver, 5G infrastructure requires silver, medical equipment requires silver. The demand is not speculative, it is structural, it is growing, and it involves the most powerful entities on Earth. Let me tell you something that will connect this to recent history. In January 2021, the Reddit community Wall Street Bets attempted a silver squeeze. Millions of retail traders tried to buy silver to force a short squeeze. It failed. Why? Because they bought the wrong instruments. They bought SLV, a paper ETF. They did not take physical delivery. They played the paper game instead of the physical game. The CME raised margins. The weak hands got flushed. Same pattern as 2011. Bernard's email explained exactly why this approach would fail. The squeeze requires physical delivery. Paper is a distraction. But the Wall Street Bets crowd could not read that email because the Epstein files had not been released yet. The playbook was sitting in those documents the entire time, and nobody could access it. Now in 2026, the buyers have learned. China is taking physical delivery. The US is stockpiling through strategic reserves. Central banks are accumulating. The lesson Bernard articulated 15 years ago has finally been understood by the players who actually have the capital to execute it. Physical delivery is the weapon. Paper is the distraction. This is finance currency. Everything I have shown you so far leads to one question. If the silver squeeze thesis was known to Epstein's network in 2011, and if the conditions for that squeeze are now present in 2026, who has been positioning for it? The answer is hiding in plain sight. And it involves the same bank we have been discussing this entire video, JP Morgan. Let me show you what they were doing while everyone else was looking the other way. In 2011, the year Bernard sent that email to Epstein, JP Morgan held 0 ounces of physical silver in their COMEX warehouse. 0. They were trading silver. They were accused of manipulating silver. They were facilitating silver investments for clients like Maxwell. But they held no physical metal themselves. By 2017, just 6 years later, JP Morgan had accumulated over 133 million ounces of physical silver. 133 million ounces. Let me put that in context. In 1980, the Hunt brothers tried to corner the silver market. They accumulated so much silver that the US government had to intervene. Silver went from $6 to over $50 during their squeeze. The Hunt brothers, at their peak, owned less silver than JP Morgan accumulated by 2017. The same bank that was manipulating prices downward was simultaneously building the largest physical silver position in modern history. They were suppressing prices with one hand and buying with the other. Think about that strategy for a moment. If you know the price is going to eventually rise because of fundamental supply deficits, what would you do? You would want to buy as much as possible at the lowest possible prices. How do you get low prices? You suppress them. How do you suppress them? You spoof the market. You place fake orders. You create artificial selling pressure. You keep the price down while you accumulate. This is not my theory. This is what they were convicted of doing. And while they were doing it, they were building a physical silver position larger than any private entity in history. Now let me connect this to the Epstein documents. Bernard's email explained the squeeze mechanism. Take physical delivery. Maxwell's JP Morgan account showed silver mining stock purchases. JP Morgan was suppressing silver prices through spoofing, and JP Morgan was accumulating physical silver at those suppressed prices. The same bank, the same time period, the same asset class. I want to be very careful here. I am not claiming that JP Morgan coordinated with Epstein's network on silver strategy. I do not have evidence of that. What I am showing you is a pattern. A convergence of documented activities that all point in the same direction. And the direction is this. The smart money understood silver's fundamental value 15 years ago. They suppressed prices while they accumulated. And now they are positioned for exactly the scenario Bernard described. Let me tell you what JP Morgan has done since 2017. They stopped accumulating. Their physical position has remained relatively stable. They are no longer building. Why? Because they are done buying. When you have accumulated 133 million ounces at suppressed prices, you do not need to buy more. You wait. You wait for the conditions to arrive. You wait for the supply deficit to deepen. You wait for the industrial demand to surge. You wait for nation states to start competing for physical metal. You wait for the weak hands to get flushed one final time, and then you wait for the price to reflect reality. We are in that phase now. The accumulation is complete. The conditions have arrived. The weak hands have been flushed. What comes next is the repricing. Now let me show you why the current price action fits perfectly into this framework. Silver ran from $37 to $121. The CME raised margins 5 times. The price crashed to $64. Mainstream financial media called this the end of the silver bull market. They said the bubble had popped. They said silver investors were delusional. Sound familiar? That is exactly what they said in 2011, when silver crashed from $50 to $30 after margin hikes. Bernard's email identified this as a flush of weak hands, not a change in fundamentals. 14 years later, the same pattern repeats. And here is what the mainstream media is not showing you. Open interest on COMEX has collapsed. It went from 176,000 contracts to 137,000 contracts. Almost 40,000 contracts liquidated. Those were the weak hands, the leveraged speculators, the traders who could not meet margin calls. They are gone now. What remains is strong money, patient money, sovereign money, the kind of money that takes delivery and does not sell. The kind of money Bernard was describing when he wrote that email in 2011. Let me give you the current inventory numbers because these are critical. COMEX registered silver is at multi-year lows. This is the silver that is actually available for delivery against futures contracts. Shanghai inventory has collapsed by over 70% in 2 years. London lease rates are signaling extreme physical tightness. The market is in backwardation, meaning there is more demand for silver right now than for silver in the future. Every indicator points in the same direction. Physical silver is scarce, paper silver is abundant. And the gap between paper price and physical reality is about to close. This is finance currency. Let me connect everything I have shown you across this entire video. Because when you see it all at once, the pattern becomes undeniable. 2011. Epstein's private banker sends a detailed silver squeeze thesis. The mechanism is physical delivery. The conditions are supply deficit and industrial demand. The prediction is $150 inflation-adjusted value. 2010-2011. Ghislaine Maxwell buys millions of shares of silver mining stocks through J.P. Morgan. 2011-2019. J.P. Morgan suppresses silver prices through illegal spoofing while accumulating 133 million ounces of physical silver. 2020. J.P. Morgan pays $920 million for precious metals manipulation. 2023. J.P. Morgan pays $75 million for their banking relationship with Epstein. 2025. United States classifies silver as a critical mineral. 2026. China implements export controls on silver. 2026. COMEX and Shanghai inventories collapse to multi-year lows. 2026. Silver crashes from $121 to $64 after margin hikes flush weak hands. 2026. Silver currently trades at $82 while inflation-adjusted fair value exceeds $200. Every piece was visible in that single email from 2011. The mechanism, the timeline, the pattern, the target. Bernard identified it 15 years ago, and every year since then, the conditions have moved in the direction he predicted. Not approximately, precisely. Now let me tell you what I think this means. I hold silver. I hold mining stocks. I have been transparent about this throughout my series on finance currency. But I did not buy because of an email from the Epstein files. I bought because of the data, the inventory numbers, the lease rates, the backwardation, the government classifications. The Epstein document simply confirmed what the data already showed. The smartest money in the world has known about this trade for at least 15 years. They have been positioning while suppressing, accumulating while manipulating, building while waiting. And now the wait is over. The conditions Bernard described are present. The weak hands have been flushed. The physical market is tighter than at any point in modern history. The players are no longer small funds and retail traders. The players are nation-states with unlimited capital and strategic imperatives. You cannot margin call China. You cannot flush the United States Treasury with position limit increases. Sovereign buyers take delivery. And when sovereign buyers take delivery of a market that is already in deficit, in backwardation, with collapsing inventories, the price has to adjust. Not might adjust, has to adjust. Because you cannot deliver silver that does not exist. I want to leave you with something actionable. First, verify everything I showed you. The Bernard email reference number is FA01165353. The Maxwell J.P. Morgan statement reference is FA01520542. These are publicly available in the DOJ Epstein document library. Search them, screenshot them, save them. Because documents like this tend to get memory hold when the news cycle moves on to the next celebrity scandal. Second, understand what you are looking at. And this is not a conspiracy theory. This is documentation of how the ultra-wealthy analyze and position for major market moves. When a private banker to one of the most connected financiers in history writes a detailed squeeze thesis and attaches CME position documents, that tells you something. The top of the financial food chain was not dismissing silver as a relic. They were studying the exact mechanics of how to corner the market through physical delivery, and they identified the thesis that is now being executed by governments. That is not coincidence, that is a playbook. Third, ask yourself the right question. The right question is not whether this email is authentic. It is. The DOJ released it. The right question is not whether Bernard's predictions were accurate. They were. The data proves it. The right question is this. What are the people in Epstein's financial orbit doing right now? What are the private bankers and wealth managers and family offices doing in 2026 when every condition Bernard identified has been met? when nation-states are competing for physical supply, when inventories are at historic lows, when the weak hands have been flushed exactly as he predicted, when J.P. Morgan sits on 133 million ounces accumulated at suppressed prices, what do you think they are doing? I think they are waiting for the same thing Bernard predicted in 2011, the squeeze. And I think the squeeze is no longer theoretical. Here is my final message to you. If you have watched my entire series on finance currency, you now have the most comprehensive picture available anywhere. Video 1 showed you the vault drains. Video 2 showed you the price targets. Video 3 showed you why the crash was a trap. Video 4 showed you the US-China supply war. And this video showed you that the thesis has been circulating at the highest levels of global finance for at least 15 years. The only difference between 2011 and 2026 is that the conditions are now real. The deficit is real, the demand is real, the inventory collapse is real, the sovereign competition is real, and for the first time, the players executing the strategy are too big to be flushed by margin manipulation. Send this video to someone who thinks the Epstein files are only about politics. They are about money. They are about markets. They are about a thesis that is playing out in front of our eyes. This story is not over. It is accelerating. And the documents just gave us the blueprint that shows the smartest money in the world has known this for 15 years. The question is what you do with that information now that you have it. This is finance currency. Subscribe if you want to stay ahead of what mainstream financial media refuses to cover. Drop a comment telling me what you think about these documents, and I will see you in the next video, because the silver story is far from over.